Do you want to buy rental properties, but you don't fit the approval box for regular investor mortgages? Maybe you're self-employed, you recently left your job, or you've already hit your loan limit. In this episode, we're diving into DSCR Loans, a powerful financing tool that's based on your rental income and not your personal income. To help me break it down, I'm joined by Bryan, a mortgage expert and investor who knows how to help people like you keep growing. Let's get started. So Bryan, I'm thinking back to like 20 years ago or 22 years ago when I was a new investor. I wish I had the tool of the DSCR loan, which we're going to talk about what that means here in a second. But I wish I had that when I was growing my portfolio, because I didn't have access to a 30-year fixed financing with not having to have W-2 income stats and all these big stacks of paper you normally have to have. I couldn't get 30-year fixed financing as in the scenario I was as an entrepreneur, and it would have been a huge benefit. And so what I want to talk about today is that we're in a really, I think, kind of a golden opportunity with the financing world right now to have this particular tool for real estate investors called a DSCR loan. And you're the guy to talk to about it because you help a lot of investors get these loans and you understand the ins and outs and just the details of it. So maybe a place to start is, let's just talk about the basics. Like, can you explain what a DSCR loan is and maybe what that stands for?
It's a great place to start. So debt service coverage ratio. Debt service, that's your monthly payment, right? You're servicing your debt. Coverage ratio, coverage is your rental income. And then ratio is how much income do you have versus your payment. So most lenders, they want to see a DSCR of a 1.0, a ratio of a 1.0, meaning you have at least $1 coming in rental income for every $1 going out in payment. For payment, they're looking at the principal, interest, taxes, insurance, plus HOA if there's an HOA. So it's your holding cost of the property. And all we're looking at is the rental income and the payment.
Wow, you simplified that. I was going to ask follow-up questions, but I think you kind of nailed the basic idea is that they're looking at the rental income of the property. So for those of us who are rental investors, the lender just wants to know that their payment's covered plus some of those main expenses, taxes, insurance, HOA fees, things like that. And we'll go into the ratio and the math a little bit here in a little bit, but
yeah.
Can you, what's different about a DSCR loan just fundamentally than maybe something a lot of people are familiar with that you also do a lot of loans with conventional loans, or Fannie Mae, Freddie Mac loans are another term people have? Like what's the kind of core difference between these two basic types of loans?
So the biggest difference is flexibility, right? Fannie and Freddie, conventional loans, they have a box. You've got to fit inside that box for lending to work. And it's this way or the highway. If you go to any lender, they're all going to have the exact same guidelines because it's a national published set of guidelines. Fannie says we're going to buy mortgages if it fits inside this box. Now you can get to some lenders who have overlays. They might say, hey, you, Mr. Customer, if you had a bankruptcy 6 years ago, we won't give you a loan. Fannie Mae says you can have a bankruptcy 4 years ago and you can still get a loan. But the lenders decided to be a little more restrictive or more conservative, right? So they're going to opt to have a narrower box. But every mortgage company is going to follow the same exact guidelines. When we switch over to the DSCR loans, what we have is flexibility. Most of the guidelines started where Fannie and Freddie left off, right? So the base core of the guideline is very similar. And a lot of lenders now that do DSCR loans, they also do Fannie and Freddie mortgages. So you talked about you wished you had this 20 years ago. Well, even 5 years ago, there was not DSCR loans on short-term rentals, right? Fannie and Freddie don't recognize that income style. They look at the long-term rent or the rental income on tax returns. But now we can have a flavor of DSCR that is a little different from other DSCR loans. And if I work with 200 lenders, I'll get 200 different sets of guidelines. And a lot of them rhyme each other, but they're slightly different. So the biggest thing that we get with DSCR is flexibility. The first and obvious flexibility is we're not looking at your debt. We're not looking at your income. No W-2s, no tax returns. We pull credit because we want to see how good you are at paying your bills, and that's going to determine your rate. That's a risk factor. But we don't look at the amount of debt on your credit report as a factor on, do you qualify for this loan? So the first easiest flexibility is, how do we look at the income?
Got it. So if we're going down a road to get a loan as an investor, there's a fork in the road here between conventional loans and DSCR. And one of the biggest forks is how they qualify the income to support the debt. So every lender in the world wants to know that you have enough money to pay the debt. But a conventional loan has this pretty tight little box where they say, we verify income by saying, how much money do you make at your job? We want to see a really stable job. We want to have W-2 reports that show that you have the job. And if you were like me when I was a new investor and I'm just like a full-time entrepreneur, which means I'm unemployed as far as the Fannie Mae lender looks at, that doesn't qualify to their box. Whereas
Correct.
the DSCR box, which has a lot of variety we're going to talk about in this episode, but the box says that we want to look at the property for the income, not necessarily you personally for the income. Is that an accurate kind of fork in the road there?
That's exactly right. And so one's not better than the other. Fannie Mae, Freddie Mac, there's a reason to go for that loan. Oftentimes, if you qualify, it's likely superior because it may offer a little better interest rate. It doesn't have a prepayment penalty, but there's some downside. If you want to own your property in an LLC, Fannie Mae does not allow you to close directly in the name of an LLC. You're allowed to transfer it into an LLC after closing, but you can't close in the LLC. And a lot of people, they want to kind of keep their name off of that mortgage or that security instrument, where DSCR allows you to record directly in an LLC with many, many lenders. Some lenders don't, but that's where when we have a whole bunch of lenders to choose from, I get to know you, Chad, and decide what is best and most important for you. And we might decide, hey, Chad, I have enough income. I can support this payment with my other debts. I'm going to go conventional. But you might be like, but wait, I don't want this credit, this mortgage to report on my credit, and I want to close on my LLC. Well, now we're not going to go with Fannie or Freddie. We're going to go down the DSCR path. So it's just got more flexibility and the opportunity to make some decisions that Fannie and Freddie don't allow you to make.
Yeah, I like looking at it like you'd explain there. It's not better or worse. Like in every investment decision you make, there's just trade-offs. And
That's it.
Conventional loans have been the traditional way, both as an owner occupant and as a investor, that if you can get, tell me what the cutoff number is, but maybe if you up to like 5 or 10 loans,
10. You can have 10
10.
investment properties.
Okay.
Yep.
So
You can always buy a new primary residence though. So you can have 10 mortgages and you can go buy an 11th house with a Fannie Mae loan if you're going to live in that property.
Got it. So if you're a person who has good credit, you have good income at your job, and you want to get the best interest rate, and you're not worried about putting in your personal name and having to, conventional can be a great route to go. It's still good for both personal residents and for buying some investment properties. Then we have this whole other category, DSCR, for more flexibility. And one question I would ask before we dig into some use cases and some more nitty gritty details, like who are some of the people you see as typically best fits for DSCR? So maybe you could think of some categories of investors. Is it people who get a little too big and they have more than 10 loans? Is it people who are self-employed? Like, can you kind of paint a picture for the typical people you're seeing using DSCR?
So obviously, if you're proudly unemployed because you're a real estate investor, that's a very, very clear path to going towards a DSCR loan because the tax returns aren't going to support the payment. So that's an obvious no-brainer. You might be someone who's really busy and you just want less paperwork, right? DSCR still has paperwork. We often call it a light doc loan or a light documentation. So it's going to be less paperwork than if we go Fannie Freddie. So you might just decide for the convenience. You might be self-employed and you're making really good money, but self-employed for Fannie Freddie, you have to do that for 2 years and use a 2-year average. So it might just be that while you make really good money, it doesn't yet qualify. So that DSCR is a backup plan. A lot of times, DSCR loans are going to be a backup plan if we're having a hard time getting into conventional financing.
Got it. Okay. That paints a picture. I've also heard, and correct me if I'm wrong on this, though, in that flexibility umbrella of DSCR, even people who are investing like out of the country. So we have a lot of people listen to this who are, hey, I live in Canada and I'm buying properties in the United States, or I live in, Argentina and I'm buying properties in the United States. Like, you can also have a little bit more flexibility with a DSCR loan. Is that accurate, or am I missing something?
That is. So there's actually a separate subcategory called a foreign national borrower. So a foreign national doesn't live in the United States, but wants to invest in the United States. They can't verify their income or they can't document it to the tune that Fannie and Freddie want to see. And so the DSCR loan, as long as we're making money with this property, and we can have some DSCR loans that you don't cover the full payment with the income that's coming in. So the ratios can be flexible, but foreign nationals are a fantastic use case because they have a heart, they don't get W-2s. They might get a similar document, but they might not in their country.
Right.
So the foreign national is a great use case for the DSCR loan.
Right. So I just want to paint a picture that like there's some core benefits here. It's different than conventional. It's got some flexibility. As I started the whole episode with, like I wish I could have gotten 30-year fixed financing as an investor without having, the documentable income as an entrepreneur. So that's a core benefit to me. And then just this flexibility for a lot of people in different use cases. So
right.
That's a reason to listen up. I want to talk about like as we dig into like, let's say I am interested in DSCR loan. You've explained a little bit about conventional qualifying and how the types of paperwork you have to bring. Like, what's the process look like, and what kinds of things are you looking at as a lender who's qualifying people to get a DSCR loan? Like, can you kind of paint some of the highlights of what that looks like to qualify?
Yeah. So first, no W-2, no pay stub, no tax returns. Don't need them, don't want them, don't submit them. What we are going to want is assets, right? That's your down payment money. That's your reserves. A reserve is a months of payments in the bank. So if some lenders want 6 months reserves, that's 6 payments in the bank. Some lenders want you to have a percentage of the outstanding mortgage balances on your credit. So they still look at your credit report and they'll measure, you owe $1 million in mortgages. We want you to have 2% or 4% of that outstanding balance in reserves. In addition, maybe 2 reserves for this property that we're purchasing.
So in general, like a general rule of thumb, and this is probably a good rule of thumb anyway, but the more you grow, the more mortgages you have, the more cash you need to have to set aside in reserves. Like I think that I always tell people that's a good idea anyway, but in general, the lender's also going to be saying that. So a little bit of an aside here, Bryan, but like whenever I've had a couple of podcasts where I talk about cash reserves that I like to set aside. So for example, if I have one rental property, I might want to have $5,000 that I set aside just in case the heating and air goes out. You just don't want to be like putting stuff on credit cards. Like that's my point. So if I got up to like 10 properties times $5,000, it's very plausible that you'd have $40,000-$50,000 set aside for 10 properties. Is that sort of in the range of what like a lender would want to look at to see how much cash you have? Or is it like, you said 2% of like a loan amount? I guess we could figure that out, but just wondering if that's in the ballpark.
Yeah, when we look at a lot of guidelines start with Fannie and Freddie, right? So they're gonna morph away from what Fannie Freddie require. And Fannie looks at the number of financed properties you have, and then it changes the reserve requirement as the number of properties you have increases. When you're between 6 and 10 properties, Fannie and Freddie want you to have 6% of your outstanding mortgage balances plus 6 months PITI of which is principal, interest, taxes, and insurance of the property you're buying. So 6%, Chad, if you got 10 mortgages, that might be, $2 million. You're getting up there in the amount of reserves that you need to have to qualify. But to your point, you probably want to have those reserves because that's 10 air conditioners and 10 water heaters and 10 roofs that all could go in the same bad winter, right?
Yeah, that could be $120,000 at 6% for $2 million worth of debt you have, right? So just to give people context, it's a healthy reserve, right?
As you grow, that gets bigger and bigger. Now, when we look at DSCR loans, some lenders, they don't care how many mortgages you have. They're looking just for this subject property. How much do you have right now for this property? And they might say 6 months reserves is enough. Other lenders, they might take that same percentage approach. And then some lenders may say somewhere way in between. So there's not a golden rule in the DSCR space because every lender gets to make up their own rules. Generally speaking, you need at least 6 months for every purchase that you're going to do. And if you don't have a big amount of reserves and you have a lot of mortgages, it's just going to restrict which lenders we can go to. We've got to pick a lender that's suitable for your specific needs and qualifications. So we just have to shop that around.
Yeah. I think the message I'm trying to convey to everybody is like, there's no free lunch. Like even though one thing's a little easier, there's always like lenders want to see that you have some padding, some cushion. And, as an investor coach, I'm always telling people that too, like you need to have like some cash reserves. So just in general, as we're preparing to get DSCR loans, it makes some sense to like set some cash aside. Don't try to get
Right.
so thin on your margins. Like instead of doing the next deal, you might need to save up some cash to pad your reserves a little bit. It might take a few more months later, longer, but that's part of a safe way to grow your business.
And to that point, the less reserves you have, the less lenders we can shop with. It is a higher risk profile.
Hmm.
And lenders offset risk with interest rate. I'll take a bigger risk, but you got to pay me a little more for me to want to take that risk. So as we really cut out all of the lenders that, if you qualify for everyone, you're going to get the best rates always. But as we pare back what lenders are going to consider you a good risk, their rates are going to be higher because they're doing riskier and riskier loans.
Makes sense. Okay. So reserves, that's one of the things that people need to think about for qualifying for DSCR. You also said earlier credit score. Is there a general rule of thumb on like what ranges we need to be in to be able to qualify?
Generally speaking, that 660 to 680 mark is going to open up most doors for you. We've got a small set of lenders that they only deal with 720 and above. 700, most lenders you're going to get access to. And then when you get under 650, it's going to become slim pickings. So there are some options. You're really that 660, 680 is probably a great kind of, I don't want to say it's a minimum target, because if you've got a 620, I've got a lender that can help you. You're just not paying a really pretty interest rate. But if the deal's got a lot of juice, right? If it's a good area, it's a good rental income, then sometimes rate is just one factor we have to consider.
What about down payment? So credit score, we got cash reserves. Like what's a DSCR lender going to look at to say how much down payment you have to make or how much equity above the loan do you need to have?
Yeah. And when we look at the equity above the loan, they're looking at the purchase price. You might be buying a property at half the value on the street, but they're still looking at what are you paying for it, and they want you to have skin in the game.
Okay.
So even if that property is worth 400 grand and you're buying it for 200, you still need a down payment. And I get that question all the time, but I'm getting at this property at a steal. Right. But if it doesn't work, you walk away and the lender's stuck holding the bag. They want your skin in the game. 15% down is the bare minimum across all loan products.
So that's the minimum. So is it typical? Like obviously, the more money you have down, the better you're qualified you're going to get on a loan, I would guess.
Yeah, and it's a risk factor. So the less money you have in that deal, the easier it is for you to walk away. It's a riskier loan. So when you look at interest rates, 15% down is going to give you the highest interest rates. As you add 5%, your interest rates are going to get better and better. So 20% is going to be way more common as a down payment. When you're borrowing more, your payment's higher and you have a higher rate, which makes your payment higher. And all 15% down options, they want to see a minimum ratio of a 1.0. There's not a 15% down option if your rent isn't covering that mortgage payment.
Got it.
So sometimes we have to put more down because our projected rental income is lower. And we wanted to put 15% down. We have great credit, 800. But if our payment doesn't cover or our rent doesn't cover the payment, then that 15% down is not an option in that instance.
And the other thing I want to talk about actual practical applications of DSCR. So I know some people are thinking like, well, I want to actually like buy fixer upper properties, fix them up, add the value, and then pull my money out. And couldn't. So we're going to talk about how do you refinance with a DSCR. It's a little different case study use case, but there's also going to be people very often today, we're in 2025 recording this, is that even though you want to put 15% down, in order to get the debt payment down low enough that there's an actual coverage that's going to work, I'm assuming that because interest rates are a little bit higher, you probably have to put more down in many cases with today's property prices in order to get the debt coverage ratio anyway. Are you seeing that? Is that a normal
Very
thing?
much. Especially on a single family residence, it's really hard to buy a street value property, right? A market value property at today's rates and get rent to cover the payment if you're putting just 15% down because you have an elevated rate, because it's 15% down, and your purchase prices. I don't feel it's 2025 and let's look at this in 5 years, but I don't feel like we're going to have a massive reduction in sales prices in the next 5 to 10 years. Maybe builders aren't building fast enough to really suggest that we could see a big pullback in real estate values. And rent, some markets you can get more rent than others. If you go into a duplex or a quadplex or a multifamily 2 to 4 unit, it's much easier to get enough income with 15% down. It's not always. So sometimes we wanted to do 15% down, but our rent is just not going to cover that payment. So we've got to put that 20 or 25% down.
That makes sense. Yeah, I use this analogy sometimes where I say, you got to know the strategy before you go get the financing. You got to know like what game are you playing within the real estate world. And so some people are playing this game where they're super busy at their job. They have a day job that makes good money. They have like 5 or 10 hours a week to invest in real estate, and they're just buying these basically turnkey rentals on the side in a good location. Those people, in my experience, are often having to put like big down payments. They're having to put 30%, 40%. And often they're either going a conventional loan if they can, or in some cases a DSCR loan. So that's like one major strategy a lot of people are doing these days, turnkey. I call it like the boring rental strategy. Just put a big down payment, go with it in a good location. Don't try to do fixer uppers, just do that. And then there's this other category of buying fixer upper. They're like the more entrepreneurial investors who are trying to buy properties at 10, 20, 30% below the full value. And they're buying with, they need work, they're fixing them up. This is like the classic BRRRR strategy: buy, remodel, rent, refinance, repeat. So I want to point that out as we get into another part of this conversation of saying, some of you are going to be in like the boring turnkey rental strategy. Some of you are willing to do some of the fixer upper work. And it's just going to depend on which one you're in as to like whether you're just going to need to come up with a big down payment and do that, or whether you could do the second strategy, which I want you to talk a little bit about, is if somebody says, well, I want to recycle my down payments. Like the reason I'm getting into real estate is that I have, 50,000 or 100,000 saved up, and I want to like make that work over and over again. And I'm willing to hustle and find deals. Like, let's talk about a strategy, how DSCR could help with that. So we said earlier, you got to put 15% down minimum. How could they do a deal maybe where they have less than that in it, but they had to like buy the property and fix it up and do that? Can you go through that mechanics of how that might work?
Sure. And that's, that's the forced appreciation, or that BRRRR method, right? So we're buying a property under market value. We're maybe going to do some work to that property, and we're going to need to refinance because we're in a temporary loan, or maybe we bought it with cash and we're fixing it up with our cash. And then we want to get that cash back to put it back to work after we finished this project. So when we look at a refinance, we have two types of refinances. We have a cash out refinance, which is where we're putting money into your pocket in any way, shape, or form. If money goes into your pocket at closing, it's a cash out refinance. Generally speaking, we have access to less debt when we're doing a cash out refinance. 80% is probably the top end, and you're going to really pay for that extra 5%. Most lenders will go up to 75% of the value of the house. And we're looking at the new appraised value. When we look at a rate and term refinance, which is our second type of refinance, that's doing a refinance and paying off a loan, but not putting money in your pocket at closing. So if we do a rate and term refinance, we have some lenders that will go up to 85% of the value of the home. Most lenders want to keep it 80%. Fannie Freddie, that conventional loan, they still want to keep you at 75%, even on a rate term refinance. So when we go above 75% in the DSCR space, we are going to pay a premium, but sometimes that lets us roll in our closing costs, and it lets us keep those extra dollars in our pocket to go do one more project. So it's a trade-off of, do I need those extra dollars in my pocket to do another deal? Or do I go ahead and just leave some cash in this deal to make my monthly payment or my cash flow a little bit better?
Got it. Yeah. So if you're trying to get your cost, like you're a buy and hold investor and you want the lowest interest rate, the best terms possible, you need to probably count on, hey, you need to do what the lender, the lowest risk for the lender, which is putting a bigger down payment or having less refinance amount. So 75% or less. Whereas if you start getting up in that 80, 85%, it's possible to do it, but it's going to cost you on the interest rate, and it's going to cost you on a little bit more on the terms.
People ask me, can I do this? And sometimes I'll say, yes. I don't know that you're going to want to, right? Because if you're doing an 80% cash out refinance, you might be paying an interest rate that's 1 or 2% higher than if you kept it at 75%.
Okay. So let's go back to the deal. You buy a fixer upper, somehow you get the money to buy it. So that's somehow a couple of common scenarios. Maybe you could tell me, what are some common scenarios where, plan A is I have just the cash sitting there in the bank. That's not everybody. Most people don't have that.
That's easy.
All right.
It's hard. It's hard to have the cash in the bank, but it's easy decision to make if you've got it.
All right. So you got, let's go through that scenario. I have 250,000 in the bank, and I just happen to, have that money, and I buy a rental, I fix it up, and now I'm going to try, the property's now worth 350, and I'm going to try to pull my money back out. Like, what does that look like?
Yeah. So then we're going to look at your scenario, and we're going to look at how long you've owned that house. If you bought that house a month ago and it was a really easy fixer upper and you're able to refinance just 30 days later, most lenders are going to use your purchase price as the value of the home. That's called seasoning the title or seasoning the property. So if you've only owned it 30 days, many lenders are going to say, I'm not going to lend you more than you paid for this house because you might run off with my money. And so they're just going to have a 6 or a 12-month seasoning requirement where they're not going to use the current full appraised value. Other lenders will say, well, if you bought it for 200 grand and you spent 50 grand on the rehab, so you're 250 all in, we'll give you back your 250 because you're still under 75% of the value of this house if it's worth 350 now. So you've got a good amount of equity. We'll give you back your cash so now you can go recycle and go do this again. And then we do have some lenders that will say, you know what? We don't have a seasoning requirement. You bought it for 200, you put 50 in it. We'll let you go up to 75 or 80%, even though you've only owned it for 30 days. So there's a lot of flexibility. You're going to pay a lot more in interest doing that 80% cash out with no seasoning compared to if I did hold it for 6 months. So many more lenders now can do that loan that we're going to be able to find you a better interest rate. So we just match the right lender for you. And you don't want your funds idle, right? Some people are like, well, I want to save the rate, so I'm just going to wait until I own it for 6 months. Well, if you miss 3 deals, how much money did you lose by trying to save a couple bucks?
Yeah.
So there's not a best. It's just best for your situation. If you find no other properties to buy and you're at 4.5 months when you contact me, man, let's wait until we get to that 6-month mark. We might save 0.5%, and that money's got nowhere else to go to work for you anyways.
Got it. So 6 months, is that a sweet spot for a lot of, do you open up a lot of lenders after you hit that 6 months?
Yeah, you're probably going to have like 80% of the lenders out there that are going to see that 6-month mark and say, yeah, we're comfortable with you getting the money back. Fannie and Freddie will do 6 months. And so that's, again, a lot of lenders, they start where Fannie and Freddie leave off. So Fannie and Freddie say, hey, if you've got this property for 6 months, we're going to use the full appraised value. So many lenders are going to match that because Fannie and Freddie, they've been doing this a very long time, much longer than all the DSCR lenders.
Got it. Okay. So I like these general rules of thumb. There's a bunch of nuance. This is the kind of stuff you need to talk to Bryan about to like get your particular situation. But in general, if you can borrow like 75% or less, you're going to get the best rates. In general, if you wait 6 months, you're going to get the best terms as well. But hey, if you got a lot of velocity, you're finding deals, there are DSCR loans that could refinance without waiting. You can do it in 30 days, 60 days. So that's good to know that's available. Is there a difference between the scenario where I had 250,000 cash that I just had in the bank, or I had 250,000 from a home equity line of credit and I used that to buy this rental and getting that money refinanced versus having a hard money loan that gave me the money versus having a bank who gave me the money? Is there a difference between A, B, and C there of where I got the money?
So A and B, your cash or your HELOC, we see it as the same because we've got to put the cash back in your pocket for you to pay back the HELOC. So that's the same as your cash. It's not finance debt. They only look at finance debt if it's secured by the house you bought. So option C, a hard money loan, if we're doing a rate and term refinance, a lot of lenders have no seasoning to that. Even though you've only owned it for 30 days or 45 days, if I'm just paying off that loan, most lenders are going to let me use the full appraised value to determine the loan to value. And the lower the loan to value, the better your interest rate. Some lenders are going to still have a seasoning requirement on those rate term refinances. But if you can get your hard money loan to cover a majority of your cash out of pocket, and I can do a rate term refinance, it's going to be a little cheaper than a cash out. And a lot of lenders are not going to have any kind of seasoning requirement at all.
That's so interesting to me because intuitively I'd think, all right, I'm the investor who has a bunch of cash saved up and I can just do it on my own. But there's some disadvantages to me using my own cash instead of me going to a hard money lender.
This is a little bit of a change of subject, but there's a lot of lenders that will do HELOCs, home equity lines of credit, on investment properties. But there's a big number of lenders that won't do a HELOC on a free and clear property, which is really bizarre because you'd think, man, you're in first lien position. But their fear is if you don't need the money, you're not going to pay us interest, right? And so they're in it for themselves. So your logic, the mortgage industry is not logical. It's all about protecting the lender. They win first always. So That's why they make the rules they make.
That's the rule of the financial jungle, is that the lender will win.
The lender, yeah, they're the house. The house always wins,
the
right?
house always wins. They also have good lobbyists. They also have good, a lot of the people who used to work at banks are now working in Congress or wherever. So anyway, that's
Right.
a totally separate subject, but don't try to fight the banks. That's the rule number one in the jungle.
Well, and the second biggest rule is the golden rule. Those with the money make the rules, right? And so
There you go.
play my game and I'll play ball. But
Yeah.
if you don't want to play my game, you can go elsewhere.
Yeah, we can like it or not, but let's at least just know the rules here. We got this.
That's right.
All right. So I went on a little tangent there about how to go through a refinance. I think that's so many people want to do that's a really important nuance to get. So I'm glad we went there. I want to talk about continue talking about different strategies. We talked about like the BRRRR strategy, the cash out refinance. What about people who are just doing different types of rentals? So I'm thinking, single family house, but they want to do like a rent by the room. I'm thinking like short-term rental. There's a lot of different variations of types of rental exit strategies these days.
Right.
How does that fit into DSCR? And particularly, how do you like verify the rent on some of those, non-standard, they're not long-term rentals. They're these different short-term rentals and rent by the room kind of strategies.
That is such a big question. We could have a whole nother conversation just about that.
We will down the road, but
we will probably follow up with that. But if I have 220 different lenders, I might get 220 different answers to that question.
Okay.
In reality, baseline rental income is long-term. That's easy. Every lender is going to do that. Baseline short-term rental income, we're probably going to be at about a third to maybe a quarter of those lenders are going to use a short-term rent analysis to see if you're covering the payment with your rental income. Now, sometimes they might want a 1.25 ratio or a 125% of your payment in income. Sometimes they're only going to use 80% of your short-term rental. We use a tool called AirDNA that will go out and survey that area and that size house, and it'll predict what the rental income should be for short-term rentals. For rent by the room, that one's really difficult. Out of 220 lenders, I think I have 5 or 6 that can look at the rent by the room model and say, we'll use that. Now, there's a lot of variations on the rent by the room. You could have sober living. You could have student housing. You could have, pad split housing. So there are going to be nuances within the nuances of how lenders like to see you do that rental income. I've got one client that does rent by the room, but they get a master lease. So they have one lease. They have all 4 students sign the same lease. And now it's a long-term rent. It just happens to be signed by 4 people and it's higher than your normal market rent. That's a much easier type of rental income to verify and justify and to qualify with different lenders. So we really have to break down the multitude of variations within some of those main categories.
Got it. So if we had a general rule, correct me if I'm wrong on these, but in general, these other strategies, short-term rental, rent by the room, especially short-term rental is going to have more than the others, but you're going to have more conservative debt coverage ratio as you get into those. So you're not going to be able to use like a 1.0 ratio. You might have to have you have to prove they have more income in order to go to those other strategies.
Sometimes some lenders, not always. It's so hard to think. We think about conventional loans because we've been doing them for so long and there's one way to do it. But when we get into the DSCR space, there are so many ways to do it that your assumption is very well for most lenders, but not all lenders. So do we have another few of the outliers, right? The outlier lenders will say, yeah, we'll take a still 1.0, but you have to have that rent for a year before we count it. Or, there's going to be some kind of qualifying effect to the rental income we're using.
Well, that brings me to my next question, because I think some people are thinking, well, how do you prove the rent that you have? So like I buy a property, it's sitting there vacant. Like, do you like do an appraisal for the rent and the appraiser says, hey, here's what the rent should be? Or is it better, or do you get rewarded by the lender for having seasoned it for 6 months or 12 months and say, here's the rent I've got for the last 12 months. I proved it. Like, is there a difference between those, and how does the lender look at that?
Yeah, so many lenders are going to order a rent schedule. So that is an appraiser going out and surveying the landscape for a similar house. And most commonly, we're going to use a 1007 schedule on an appraisal. And so that's a market rent analysis by the appraiser. It's going to determine a projection for rent. Now, if the house is in service and you've been getting rent for 2 or 3 months or 6 or 12 months, depending on the lender, you might have way more income coming in than what the 1007 shows. And some lenders, not all, but some lenders will take the higher of the 1007 and your actual rent if you can prove it for 2 or 3 months or 6 months.
Yeah.
Some lenders will say, we'll take that higher income up to 120% of the 1007 rent schedule. So that's one of those questions where I might get 200 different answers on exactly how they look at your actual rent versus what the market rent is. As far as I just finished my rehab, my property's empty, can I still go get a DSCR loan right away, or do I have to rent it out? A lot of people say, I've almost rented it so I can refinance it. We have a lot of lenders that as long as you show it listed for rent, they're good with that. So you don't always have to have the house actually rented in order to do a DSCR loan. We can use the projected rental income oftentimes.
Interesting. We keep coming back to your original statement, Bryan, that like one of the big benefits of DSCR is the variety or the flexibility they have. And so I keep trying to pin you down with like, well, what about this? What about this? And it's like, no, there's 250 different lenders, Chad, and they all do it. So there's some general rules here, but I think one of the takeaways I'm getting here is that there are some broad benefits you can kind of lump all of these under, but there's a bunch of variety of things. So if you have a particular case and a little idea about how you want to invest and this little niche you're doing, like you need to ask Bryan, you need to talk to somebody and say, how can I get the best loan with this situation, and just paint it out? Because that's what's cool about you, Bryan, is you understand as an investor yourself, like here's what an investor's thinking, like here's what the lender's thinking, like let me match those two worlds together, because there's a lot of variety in these answers that you're giving.
Well, Chad, to your point, in June of last year, I left the retail mortgage world, right? So I worked for one of the big mortgage companies that, and you can look it up, it's not secret, I was at Guild Mortgage. Everybody in the mortgage industry, you can see their history online. So when I was at Guild, I was limited to what the options that Guild provided to me for, because I worked for the bank and I was restricted to doing what the bank allowed. So there might have been short-term rental or DSCR for pad split homes, but if the bank says we're not interested in that, I can't do it because the bank has made the determining factor. We're not going to do these loans. So now that I don't work for the bank, I don't represent the bank, I represent my client. And there's a huge landscape of lenders out there. And if I go to a lender and they say, no, I don't call my client and say, sorry, the bank said no. That's not my answer. It's, hey, this bank said no. We're going to transfer your appraisal. We're going to move over there. We're going to keep moving forward. We just have to find the right lender for your situation.
All right. So I could ask questions all day on some of these, and we'll follow up at another time. But I want to switch to a topic that one of the benefits, Bryan, of you having done so many transactions with DSCR loans is that those of us who are newer to this, who are just trying to learn about DSCR, the big danger is we don't know what we don't know. Like we don't know the problems. And so I want to ask the question, what are some of the most common mistakes that you see investors making when they try to get into getting DSCR loans? What are some of the things that they don't know that we should know about?
One of that first one is, hey, I haven't rented my house out, so I don't have access to money. And while that's a true answer for many lenders, there are so many options now that you can actually get access to your funds back quicker maybe than you think. One of the things that I see all the time is someone is under contract, or they've already done their financing on the hard money, or they use their cash, and they kind of shoot themselves in the foot because they don't allow us to be creative in their financing. So I love getting involved when you're making your offer on that house. Even if you've got a private money lender, sometimes we can be strategic with how we set up the loan on the first purchase that's going to make our financing cheaper on our second transaction, on our refinance. And so I think first off, there's never a too early of a time to get a lender involved in your transaction. Even if you got private money, your cash under the mattress, or the HELOC that you want to use, let's still talk about it, because you might not know that, man, if you would have done it this way, we could have had access to some superior terms. Definitely don't put cash in your bank account. That is a big, big no-no. Nobody likes to see cash. People will go close credit cards. Don't go close your credit cards, right? Pay them off, leave them open. So the biggest challenge that I find is that people have done something and then consult with me about what they did, instead of checking with me and then saying, hey, should I do this or should I do that?
So two lessons. Number one, start early in your consultation with your lender instead of waiting to the last minute. It's not just, hey, it's time to go get the loan, let me go talk to the lender now. It's like actually have a consult with you so that you can kind of guide you through the process. The other thing I heard is just begin from the end. Like you're going to end up with a rental property 6 months from now that you're going to hold for a long time. You might as well like work it backwards from there. Even if you're using private money or a home equity line of credit or whatever, talk to your lender about the strategy and then work it backwards, because there's a bunch of steps. And
Right.
I've already heard you talk about 3 or 4 today of like, if you do this differently, if you, instead of paying cash, you use a private money loan, all of those factors are pretty complicated. And so having somebody help you kind of step by step think through you would avoid some mistakes by doing that.
It could save you some money, right? At the end of the day, nobody wants to pay more than they have to. And sometimes we think about cost and we do things to save cost on the front end. But what we've done is we've created opportunity cost on the back end, where now we're restricted in what we can do. And saving the cost was nice, but I'd rather have the opportunity cost not lost instead of the cost lost, right?
Yeah, got it. There's another, we've talked about a lot of benefits of DSCR. You can fix a long-term mortgage. It's more flexible. There's all those things we talked about. One of the things we hadn't got into it, I didn't ask you about, was some of the particular terms of a DSCR that's a little bit different. For example, prepayment penalty. Can you talk about, let's talk about prepayment penalty, and are there any other kind of things behind the scenes that might be a little different about DSCR we should know that aren't, so we don't surprise ourselves later on once we get into it?
And at the end of the day, it's the surprises that nobody likes, right? If we know about it and we're prepared for it, it doesn't feel as bad. So prepayment penalty, when we look at a DSCR loan that's different from a conventional loan, is we have the opportunity to have a prepayment penalty. Now that sounds initially negative, but what it is it's an opportunity to control your pricing. If you've got a low loan size and you've got a property you plan to hold long-term, a 5-year prepayment penalty is going to be a cheaper interest rate than a no prepayment penalty. So it sounds bad when you say penalty, but man, if I can drive my interest rate down and I'm not planning on refinancing anyways, it's not going to make sense to. Let's drive the interest rate down by pulling the prepayment penalty lever and getting a superior rate. Points. 1 point is 1% of the loan size. If you are on a 5-year prepayment penalty, it might make a lot of sense to pay some extra points and get that rate lower. You're essentially paying for your next refinance now by buying the rate down to a rate that you're not going to need to do another refinance. Credit. A lot of people make the assumption that a DSCR loan does not hit their credit. It's a mortgage that's personally guaranteed by you, and more often than not, it's going to hit your credit report. And a lot of people think, oh, I close on my LLC or it's a business purpose loan and it's not going to hit my credit. A lot of lenders do conventional loans and they got into the DSCR space because last year was a really slow year for everybody in the real estate industry. It was the slowest year since 1995. So a lot of lenders that didn't used to do DSCR loans, they don't want to lay off their staff. So they've gotten into the DSCR game. And more traditional lenders or servicers buy DSCR debt and they treat them the same as a 30-year fixed rate mortgage from Fannie Mae. So credit is a very common thing that people make an assumption on. And if you want this not to hit your credit report, we just have to be strategic with what lender we go to. Closing in an LLC, you can close directly in an LLC with the DSCR loan. You don't have to. Some people think, oh, I don't have an LLC, so I can't do a DSCR loan. You absolutely can close in your personal name. That is allowed.
Got it. Those are good tips. And going back, I want to do a vocabulary clarification on prepayment penalty. A lot of people who are experienced might know what that means, but for those of you who are brand new, what does that even mean? How does that happen? When does a prepayment penalty get kicked in? Like, when do you have to pay that?
Yeah. So a prepayment penalty is usually predetermined in the number of years. Most commonly, we're going to see 5 years, 3 years, 2 and 1 year, or no prepayment penalty. And it kicks in anytime you pay off the mortgage. So that's called a hard prepayment penalty. There are soft prepayment penalties that have kind of gone away since the interest rates got crazy with 2020 and since. But a soft prepayment penalty is a prepayment penalty that only hits when you refinance the loan. But if you sell the property, they're going to let you out of that prepayment penalty. We rarely see soft prepays. The amount of the prepayment penalty is going to be determined by the lender and by the term of the prepayment penalty oftentimes. So very common is what we call a tiered or a step-down prepayment penalty. So if you do a 5-year prepay, it's going to be a 5% fee if you pay off the loan in the first year, a 4% fee if you pay it off in the second year, 3, 2, 1, and then once you hold it for 5 years, there's no more prepayment penalties. You can also have a flat prepayment penalty, which is a 5% prepayment penalty every year. It doesn't matter how long you've had the loan. It's 5% no matter when you pay it off. So we do have to shop lenders and see sometimes what their prepayment penalty looks like. It could, on the shorter ones, it might just be 6 months of interest, no matter when you pay it off in the first 1 or 2 years.
Got it. So you do the math, and in general, you need to have a prepayment penalty make sense. You got to be in it for the long haul. You got to think, all right, I'm going to hold this property for at least 5 years. Let's settle in. It's worth me getting the lower interest rate to do that. And so, again, trade offs, which I love having these conversations, because you got to match your strategy to the financing you have. You can't just like say this is better than that one.
Yeah,
Prepayment penalties are not bad. I mean, they get you the ability to have a long-term loan if you're planning to hold it anyway. If you're trying to refinance it and play the refinance game every year, okay, maybe that doesn't make sense.
right. And we can sometimes have a DSCR loan have cheaper interest rates than conventional loans because
Mm,
of prepayment penalties and points. Sometimes if we pay 2 points on a conventional loan versus a DSCR loan, it's not every day and it's not every lender, but we can go shop. If you're able to qualify for both, we can be strategic and say, let's go with the DSCR loan because that 5-year prepayment penalty is going to actually get us a better interest rate than if we did a conventional loan that I could pay off in 6 months or 12 months.
yeah, makes sense. All right, we've gotten a lot of nitty gritty stuff, terms, interest rates, qualification. I want to kind of transition to maybe big picture and also just the future with DSCR. And the big picture question I have is, you see a lot of clients, a lot of investors who are using DSCR. What's maybe the people you see doing this using DSCR as a successful tool in their toolbox? Can you give us kind of a big picture idea of, like, if we want to replicate some of your successful clients, how are they using this as an effective tool?
So when we look at the average DSCR lender, we're really looking at someone who's planning on holding real estate long term, right? You don't want to pay a bunch of closing costs, even if there's no prepayment penalty, and pay it off in 6 months. You're better off sometimes to go do a hard money loan, which has a higher interest rate, but maybe lower fees than a long term DSCR loan. So the first thing is, this is a buy and hold product. We're really looking for predictability, right? It's 30 years fixed rate, no balloon payments. There are other products that might have better interest rates, but have a balloon. And we may want to not do that because we don't know what the real estate cycle is going to be in 5 years or 7 years. I don't know that there's a bad case for DSCR loans unless, hey, I'm hoping to sell this thing pretty quickly. Then that's maybe not the right type of financing that you want to do.
Buy and hold those. That's the big thing, is that you're somebody who's going to hold this property long run. And also, I would say you've compared the business model of conventional and DSCR and said this some of the benefits of DSCR make more sense for my business model or my situation than conventional. Is that fair
Yeah,
to say?
it's offering that flexibility. Let's take the duplex, right? Conventionally, you have to put 25% down. DSCR, you can put 15% down if the numbers work. Sometimes I'd rather have 3 properties that have thinner cash flow than 2 properties that have better cash flow because I might be in an appreciation play, right? And so there's not a right and wrong, and there's not a best. It's really what fits what you're trying to accomplish. And the flexibility of DSCR is going to let us match your lending to your goals.
Got it. All right. So if I listen to all this and I'm like, all right, I'm one of those use cases. I think DSCR makes sense for me, or at least I want to add this to my toolbox. 2 questions. Number one, what can people do to prepare themselves before they make a call to you or to a lender to start working on this? Like, what are some of the steps they can do to prepare? Paperwork should they get? What should they do on their own with spreadsheets? And then 2, like, how would they actually start working on this? Like in your case, like, what would they need to do that?
Yeah. So preparing pre-qualification for a DSCR loan is really hard because it's based on the income from the property. So until we've identified the property, we can't really pre-approve your debt to income like you can on a conventional loan. We can have general guidelines and general ideas about your buy box. I'm looking at $300,000 or $400,000 houses. I think they'll rent for $2,500 or $3,500 a month, and we can kind of make some assumptions that this is where you're probably going to see financing at. One very common thing I get is people will call me and they'll say, hey, my credit score is this. And they're looking at their credit score on Credit Karma or in their credit card company. Credit Karma shows you a Vantage 3 credit score model, and most of your credit card companies are showing you a FICO 8 credit score model. Neither of those do we use in the mortgage industry. So one of the things I tell a lot of clients is go to myfico.com and pay for the advanced membership. It's $29.95. It is a monthly subscription, so cancel after you're getting access to your credit scores. but go look at your FICO 5, 4, and 2 scores. Those are the scores that we generally use in the mortgage industry for most long-term financing. There are some outliers, but generally speaking, we're going to look at your 5, 4, and 2, and we're going to look at your middle credit score. So if you really want to be prepared and you want to have a really in-depth pricing conversation with me, don't guess on your credit score. Go see what I'm going to see. It's $30. It's a soft pull, and you can update that once every 90 days. So you can go look and see where your credit score is. So the biggest lift, the heaviest thing that we can do is getting our credit prepared. And sometimes that's going to be paying off some revolving debt or moving revolving debt off of our personal name and into a business credit card that doesn't report. Credit card debt is the number one thing that's going to pull debt when missing payments, obviously. Don't miss your payments. But credit card debt is the number two thing that's going to pull down our credit score. So getting credit prepared is going to be very helpful. And then the second main factor is your assets. Do we have enough money for down payment, closing cost, and reserves? So if we're preparing and we've got to be strategic about where we get access to money or credit, sometimes it's finding a partner. Hey, I don't have enough money, so I'm going to go find a partner that's got some money and I'm going to split this deal. Maybe you're great at finding deals, but you're bad at saving. Find somebody else who's great at saving and bad at finding deals, right? Marry each other financially and go buy a property together.
Yeah. There's a creative. If you got a will, if you're finding good deals and you end up putting deals together, that's the fun thing about real estate. I mean, you can. This is a people business. You can go to your friend and say, "Hey, I don't have the credit right now. I got the down payment, and you have the credit, and let's do this thing, right?" So that's a cool partnership.
Yeah. So I think your number 1 and 2 preparation steps are going to be credit and assets, and then number 3 is identifying what you want to do. How are you going to monetize? Are you looking at the markets? Are you looking at what short-term rentals? Are you looking at AirDNA? Are you talking to your real estate agent or looking at Rentometer or Zillow Zestimates? There's a lot of places to go look at rent. But if I'm in Charlotte, North Carolina, and you're in Washington, I don't know what your local market rent's for. And so it's really hard for someone to say, well, how much can I buy? If you don't have an idea of what that house might rent for, or if you don't know how you're going to monetize it, it's hard for me to help match your goals when you don't know what that looks like.
Yeah, and rental property mastery, almost every day I'm talking to people about buy box.
Right.
And so as a lender, I'm assuming if you have a client who comes to you and says, "This is my buy box. I've already looked at it. I want to buy $350,000 properties. Hopefully I buy them for 300 or 275, and the rents are $2,200. And here's how much money I think I'm going to put down." That's probably a different client than somebody who's just like, I don't, I'd like to buy a good deal, right? I mean,
Right.
that's a very different
Right.
conversation when they've actually done their homework on their buy box.
Having an idea, even if you don't have a house that you found, find something that's similar. Like this house doesn't work, but at least we can look at what the taxes are for that type of house in your area. At least we can call a real estate agent and see what might the rent be if you're not good at figuring out the rent. At least we can call an insurance agent and get a quote for this size of a house. The debt to payment is the biggest part of the DSCR, right? The debt and all those moving parts, taxes, insurance, and then the interest rate we'll get with your credit score.
Yeah. So you can get a rough idea just by looking at that price to rent ratio and figuring out what's feasible in that market.
Well, I'm sure, Chad, for you've got markets where 300 grand is going to rent for X dollars inside the city, but 300 grand or 250 grand might rent for the same dollars, right? So if you go kind of on the outskirts of some of those areas, you might be able to find a better ratio where I can't buy inside Charlotte, but if I get into the surrounding counties, now I'm going to have some numbers that work for me.
Yeah. So you understand the limits of your financing, and then you go to a market where you maximize your chances to make that DSCR work. That's a really good way of looking at it. Yep. Awesome. All right. So people are going to start preparing. They're going to get their credit score ready. They're going to get their down payment ready. They're going to get their buy box ready. Once they do that, I hope they've heard today that this is something you need to have a team member on to really guide you through the process. And obviously you're somebody who I've known for a long time. My friend Sean McKay, who works with me, has used you for loans for 20 years, maybe 17 years, something like that.
At least over a decade. Yeah.
It's been a long time. So I love your business and what you do and your expertise. And so if somebody wanted to work with you on this and they want to talk to you, what's the best way for them to get in touch and to kind of pick your brain about how this can work for them?
Yeah. So request an appointment. So I'm going to have a page that you can go to. You can give us just a little tiny bit of data. I do work with a good sized team, and I want to match somebody on my team to what is going to be your goals. If it's simple, I've got down payment and I'm ready to go. Get on our calendar, request an appointment, and we can match you with one of our lenders. If it's really complex, if you got some really detailed questions, you can jump on my calendar. It might take a little bit longer to get in touch with me, but I do have 7 or 8 loan officers that are on my team. They're waiting for you to fill out the form, give us some basic data, and then we're going to reach out. We're going to make a time to talk to you, learn about your buy box. We're going to talk about interest rates, what payments might be expected, and then we're going to be a little strategic, right? So, Chad, if you're making an offer on a property and you can get 2% of the sales price towards closing costs, you do that 10 times and you just saved 20% cash. That's one more house you can buy, right? So when we're making the offer, get us involved. If you call me and you're under contract, sometimes we can modify the contract, but I love to talk before you go under contract so we can take a look at that property and be strategic about, do we need some extra money to buy the rate down to make this ratio work, for instance. So we love to get involved. The earlier, the better. And yeah, the hard part is not what I do. The hard part is what the real estate agent does and what you do to go find your properties.
Yeah. 100%. Awesome. So we will have a link to Bryan's contact information so you can actually get on his appointment. So you can fill out a form. He'll get back in touch with you. I know you've been pretty good also, which I really appreciate about in the last video we had, you answered a bunch of comments. So I know if you have questions, if we talked about something today and you're like, well, what about this? What about that? Leave it in the comments below. We'd love to hear from you. We'd also love, Bryan and I both, would love to hear what other topics related to mortgage financing you're interested in. Is there anything we didn't cover today about DSCR that you're really itching to know? Bryan is a partner of this channel of Rental Property Mastery, that my community, and he's going to be helping me educate you about mortgage topics. So let us know. What do you want to hear from in the comments below? If you're listening on Spotify, you can also leave a comment and let us know there as well. Or you can send an email to podcast@coachcarson.com. Let me know what you're thinking. We'd love to hear from you. And Bryan, thanks for your time. This has been a lot of fun.
Chad, it's always fun. Thanks for having me again.
In this episode, we talked all about DSCR investment mortgages, but one thing we didn't talk about was how do you actually make money on rental properties with interest rates and prices as high as they are? So in my next episode, I want to show you how to still do that. If you're watching on YouTube, click on the thumbnail above me here, or you can click on the link in the podcast or the YouTube description below. Thanks for watching or listening. I'll see you in the next episode.